Just a couple of pointers on the format of our course. We've designed it first and foremost to be of equal use to you, whether you're just getting started in your trading career or if you're a more experienced trader. It's hard to do both of those things at once because explaining concepts up front requires a little bit more of the theory and conceptual information, whereas people who either don't frankly care about the theory or know it already tend to be more interested in practical trading examples. So we're trying to strike a good balance between explaining the important concepts where we need to, but again, making this course overall as practically oriented as we can. So hopefully you will find that it has something for everyone. Our primary focus is going to be chart data itself. There will be a few little conceptual graphics here and there, but we're really going to be digging into actual trading examples as much as possible. You're going to see that there are two types of charts. One is going to be presented in a white background, and one is going to be presented in a black background. That's IT Finance and FX Solutions' exciting new AccuCharts package, respectively. And if you don't have access and are interested in either of these platforms or both, you can get at them via these URLs at the bottom. And hopefully, if you don't know these packages yet, you'll probably want to spend some time, of course, becoming familiar with their features. We just won't have the time to cover that material off in this course. But FX AccuCharts has a really good online tutorial and a good help facility. And its layout, I find, is quite user-friendly and intuitive. So if you're a Windows Power user, you should be able to experiment and find your way around there pretty quickly. And then with the IT Finance charts, there actually is a primer on how to use them and set them up, which was submitted by one of the Forex Mentor members, which is available in the members library. So the reason we're using two different chart platforms with two different backgrounds, well, it's a good idea. Professionals use more than one platform. It's a good idea as an insurance policy. You never know if your usual service provider might be down for a few hours. That certainly happened to me numerous times, doing maintenance over the weekend, say. And so as insurance, but also to really test your comfort zone, it's good to see the same information presented in different ways because, as has been suggested within the daily AM reviews, Peter's made note of the fact that you can see things presented one way that you won't necessarily the other way. So that's in a nutshell our course format. Here then is our table of contents. You're currently in Module 1, of course, and in Module 2 we're going to start off with the very basic events that happen with MACD, the most obvious being MACD crossover, which is when MACD punches through, penetrates its trigger line, and starts heading in the opposite direction. And we're going to talk about how that can sometimes help validate a reversal setup. It's not always valid, but in Module 3 we're going to show how the invalid or fake-out versions of those signals can be spotted and how to sort of stick handle your way around them and deal with them. In Module 4 we're going to talk about the very popular subject of divergence, which is essentially when price is putting in higher highs relative to lower highs on MACD and its histogram, or conversely higher lows rather than lower lows. And we'll go over all the various permutations of that in Module 4 and how to trade those. In Module 5 we're going to review a subject that I've dubbed the trend cycle. MACD tends to put in fairly predictable behaviors from one oscillation to the other. In other words, going from an overbought extreme to an oversold extreme. There are certain readings you get along the way which tend to recur quite often and help you monitor open positions and monitor the health of the trend. In Module 6 we're going to look at neutralization, which is a pattern that helps you identify trend continuation moves. So for example, we had a strong leg down move, price goes sideways, and then it gears up to continue on down. There's some really easy to identify signals on MACD that help identify those setups. In Module 7, we're going to look at how different aspects of MACD can help confirm the very common 1, 2, 3 top and bottom patterns, just to give you greater comfort that the pattern you think you see unfolding is actually happening. MACD can help us in that regard. And then finally, in Module 8, we're going to just look at a few top-down trading examples. Not focusing exclusively on MACD, because of course we never trade that way, but showing how MACD can fit in with a whole bunch of other indicators and events to help us identify good setups, and we're going to use a multi-time frame approach with those. Not a lot of different trades, because I plan to actually use quite a few different charts for the examples we're going to look at, but enough to sort of tie all the topics together. So that's it, 8 modules to go through in our course, and I hope that by the end of it there is no stone left unturned with regards to our subject. Entire books have been written on the subject of trading rules, and you've probably compiled a list of your own along the way. This is not to imply that there are only 3 important rules, but there are 3 that are most applicable, most important to bear in mind as we go through this information so that you don't misapply it. And so what I'm going to do is just cover those off. And to a certain extent, if you're a Forex Mentor member already, this is going to be repetitious for you, but sometimes repetition is good. It just helps you keep in mind the things that are important. The first of those rules is to always insist on a confluence of events. That is to say, we might see something really enticing on the MACD panel, but we're not going to take a single indicator approach. We need to cobble together as many signals that say the same thing from as many sources as we can. So maybe one signal is kind of giving us the proverbial green light, but we also want to see this traffic cop saying, okay, coast is clear, proceed. And maybe, here's a couple other guys, maybe that's MACD to the right and trigger to the left, giving us the thumbs up, and another signal somewhere else in our chart is saying, yeah, go for it. So because we're playing a game of probabilities, we never have a 100% guarantee that things are going to go the way we expect. We take more comfort the more complementary signals we're getting together at the same time. So never trade a MACD event by itself. That would be a big mistake. Here's another reminder. Just the same way we don't ever want to take a single indicator approach to trading, we also don't want to single time frame it. I can speak with eminent authority personally on this subject. I, for the longest time, tried in a little experiment. I was going to try trading just strictly off the 3-hour time frame. I liked those sort of 1 to 2 day long trades that offered up 100 or 200 pips, and I thought I would just try to simplify my life by working with one time frame, but it just didn't work. It's just too stressful to get bad entry points and suffer through those big drawdowns and have to put on big stops. Now, if you're a position trader and you don't have the luxury of time to look at a trade in detail, you can only spend a few minutes a day, then of course that might not be an issue that you can work with, but of course that means you will have to take broader or wider stop risks in your trades. If you do have time to look at a trade, it's best to work all of these time frames together, because we know price is moving in sometimes contradictory directions all at once. You might have a high-level uptrend on your daily, weekly time frames, but your medium-term time frames, you might have a correction underway, and within that correction, you might actually have price moving up on the low-level time frames. So it's important to get a handle on these different levels and what's happening, because at the very least, you want to make sure you're minimizing your risk, you're able to put your stop at as low a level as you need without making it too tight, but without having to assume huge risk that's not necessary if you just wait patiently for that good entry point, which you can only really get looking at a lower level time frame. So there's our top-down summary, and again, just make sure that you're using at least 3 to 4 different charts, different time frames that you're looking at. If you're using less than that number, you're probably doing yourself a disservice. On the other hand, don't run the risk of analysis paralysis either by looking at more charts than you need, 10 to 12. That's probably too many degrees of freedom in your trading system. Try to keep it to a manageable level that covers all the time frames but is not slowing you down in your trading decisions. Hopefully that reminder is helpful for you. One of the best teachers, in addition to Forex Mentor of course, is experience and analyzing your own trades. So it's very important that anytime you encounter a new idea, something you've not worked with, please do not use real money to try that idea out and to get experience with it. Here we've got just a sample daily report printout of the trades we took on a one-day basis in our demo account. And it's very important that you go over trades that you're taking with a new idea for the first time in great detail. Do a post hoc review. So we see on this one day, while we're pretty happy that we got 107 pips in our demo account, and we see that we had more winners than losers, and the losers were fairly manageable. That's all nice. But you need to go through every single one of these trades if they represented demo trades of new ideas, and see where you might have gone wrong on the losing trades at the bottom, and whether there was opportunity for improvement on the trades that were successful. So having these open and close times and these prices all documented for you is very important, very useful information, because you can go back to your chart and take a look with the benefit of hindsight what was going on. Like if we're looking at this first chart, the New Zealand dollar, US dollar short position that we had here, let's take a look at our chart at the 15-minute on this date at this time and see if in retrospect the conditions really were valid for a short, or if we just got lucky, because that can happen. You can get lucky and lulled into thinking that you did something better than you actually did. And just sort of walk yourself through the trade and just remind yourself of the things that you were looking for, and were they validated by the trade, and did you get out at a good spot? Did you pick your exit point well, or did you leave way too many pips on the table? And we do those whether they're winning trades or losing trades, because again, that experience is very helpful, and the best place to do it is in your demo account. So please, if you're encountering any ideas in this course that you've never seen before, try them out, because let's face it, it takes several losing trades before you're really comfortable with a new strategy or approach, and it's best to do that in an environment where it's not costing you real dollars. Alright folks, this is the last slide in our introductory module, and admittedly what we're going to cover off here is in the realm of administrative minutiae, but hopefully you don't mind. I just wanted to make the point that there is not a lot of consistency in terms of the terminology that's used in our industry. So for example, if you're reading somebody else's book on technical analysis referencing MACD, you might come across terms that are different than the ones we're used to at Forex Mentor. So these are just some examples. For example, center line or central axis or zero line. Those are all terms that are often used for the water line, which is that horizontal line running through the indicator panel. And for example, signal line is the term that you'll see in your charting package often instead of trigger. Again, to try and maintain as much consistency as possible with Forex Mentor, we're going to stick to the same terms and the same names for different events that Peter Bain uses in his daily AM reviews. And finally, once you're finished this course, we would love to hear your thoughts and feedback on it, so please do send us an email, info@forexmentor.com, and let us know what you think. This is very important information for us because it can have an impact on future course offerings, how we deliver them and present them and so forth. So that's it for Module 1. We'll see you in Module 2.